Before we could even access the raw files for today's deep dive, I had to sit there clicking those little grid pictures of bicycles and crosswalks.
Oh, right, the security verifications.
Yeah, just to pass a security verification to prove we aren't bots. Just to prove to a server somewhere that I wasn't like a malicious script trying to scrape data.
It's always a bit humbling, isn't it?
It really is.
Yeah.
We have all this incredible world-eating technology at our fingertips, but there is still a digital bouncer at the door, making sure you are actually human before you get to the good stuff.
You know, it is a rather perfect metaphor for exclusivity.
How so?
Well, you have to prove you belong, jump through a specific set of hoops before you are granted access to the inner sanctum.
Okay, yes, I love that. And that concept of exclusivity, of, the velvet rope, is the absolute core of what we are unpacking for you today.
It really is the heart of the story.
Exactly. We are taking a deep dive into Ferrari's Q1 2026 financial results. And our mission today is to figure out a puzzle that seems to break the fundamental laws of business.
It's a fascinating puzzle, too.
It really is. We're going to explore how a company manages to grow its revenues, generate massive profit margins, and increase its brand value by deliberately, strategically selling fewer of its primary product.
Because it just defies traditional economic gravity.
Yeah.
What we are looking at in these source documents is, well, it's far beyond a standard quarterly earnings report.
Right.
It is a masterclass in luxury economics, supply chain resilience, and frankly, psychological engineering.
That's a great way to put it.
Yeah, we are looking at a company that doesn't just sell cars, it sells status, engineered scarcity, and the privilege of waiting.
Okay, let's unpack this because we need to start with the bottom line. It presents an immediate glaring paradox.
It certainly does.
If you think about any normal business, whether you're selling smartphones, t-shirts, or mid-sized sedans, if you want to make more money, you sell more units.
Right, volume is king.
Exactly, volume is king. But Ferrari is flipping that script. In the first quarter of 2026, their revenues hit roughly 1.85 billion euros.
Which is a massive number.
A huge number. And the report notes that is up 3% reported, or 6% if we look at constant currency. But before we cheer for that number, explain the constant currency caveat. Why are there two different percentages?
Sure. So think of constant currency as removing the optical illusion of global exchange rates.
Okay.
Ferrari sells cars all over the world in different currencies. Dollars, pounds, yen.
Right, because their buyers are everywhere.
Exactly. If the euro suddenly gets much stronger against the US dollar, the money Ferrari makes in America looks smaller when they convert it back to euros on their balance sheet in Italy.
Oh, I see. So it artificially deflates the number.
Precisely. It makes their performance look worse than it actually was. By reporting in constant currency, they are essentially saying, if exchange rates had frozen and stayed exactly the same as last year, our actual business growth would be 6%.
Okay, that makes a lot of sense.
Yeah, it gives you the true measure of their operational success, stripping away the noise of the global currency markets.
Got it. And that 6% true growth translates to some staggering profitability. Their EBITDA, which I know stands for earnings, before interest, taxes, depreciation, and amortization reached 722 million euros.
Which is just an unbelievable figure.
It is. That is a 39.1% profit margin. I look at typical mass market automakers, your Fords or your Toyotas, and they are thrilled, absolutely popping champagne, if they hit an 8% or a 9% margin.
Right. 10% is usually considered a phenomenal year for them.
Exactly. A 39.1% margin is a number you usually only see in high-end enterprise software companies where, it costs practically nothing to copy and paste code. You don't see it in heavy industrial manufacturing where you have to buy steel, carbon fiber, and pay highly skilled labor.
And the detail that makes that 39.1% margin so fascinating is how they actually achieved it.
Right.
While they were pulling in record profits, their actual physical shipments were down.
Wait, really?
Yeah, they delivered 3,436 units in Q1 2026 compared to 3,593 in the same quarter last year.
Wait, let me pause you there. They shipped fewer cars but made significantly more money.
That's exactly what happened.
The documents mention this was a deliberate move to ease the execution of planned model changeovers. I mean, they are phasing out the 296 family and the Roma Spider.
Correct.
And they're ramping up the 12 Cilindri, the Purasang, and the new F80 supercar. Plus, they're just starting deliveries on the Amalfi and the 849 Testarossa.
It's a massive product lineup shift.
I get that changing a production line is hard, but usually a factory retooling means a company takes a financial hit for the quarter.
It usually does. The choreography required to switch a production line from one highly complex hand-built machine to an entirely different one is staggering.
I can't even imagine.
But Ferrari didn't just weather a transition, they used it as a financial lever.
How so?
Well, the growth didn't come from volume, it came from what they call the mix and the margin on hyper-personalization.
I want to dig into that mix concept because to me, it sounds like an exclusive Michelin star restaurant actually removing tables from the dining room but making record profits because everyone left is ordering the beluga caviar.
That is a very accurate analogy.
But isn't there a ceiling to this? Are they just jacking up prices or is there real value being added?
What's fascinating here is that it is far more sophisticated than just hiking the base price.
Okay, tell me more.
The mix refers to the proportion of their most expensive top-tier vehicles compared to their standard models.
Gotcha.
For example, the new F80 supercar and their special series cars made up 11% of all shipments this quarter.
Wow, 11%.
Yeah, those are the absolute pinnacle vehicles. But the real secret weapon, the margin multiplier, is the personalization program.
The custom stuff.
Exactly. When someone at this level orders a Ferrari, they are not picking a factory color from a glossy brochure. They are selecting bespoke stitching, unique carbon fiber weaves.
Like completely custom.
We are talking about custom leather dyed to perfectly match a favorite vintage briefcase.
Oh, wow. So it's not just about owning a Ferrari. It's about ensuring your neighbor in the gated community knows your Ferrari is rarer than theirs.
It is the ultimate status flex within an already elite group, and the margin on those personalizations is astronomical.
It's basically pure profit, isn't it?
Almost pure profit, yes. You are paying a massive premium for the craftsmanship and the uniqueness. So they build fewer cars, but each individual chassis rolling out of Maranello is significantly more valuable.
That is brilliant. And beyond the cars themselves, the financial documents highlight a structural advantage driving that margin, the new patent box tax regime.
Ah, yes, the patent box.
They noted it gives Ferrari a highly favorable 23% effective tax rate.
Yeah.
I initially read that and assumed they just found like a clever accounting loophole.
It's actually not a loophole at all. It is a deliberate government incentive.
Really?
Yes, the patent box is an Italian tax regime designed to reward companies for keeping their intellectual property and their research and development physically within the country.
Oh, that makes sense. Trying to keep the talent at home.
Exactly. It provides a massive super tax deduction for costs related to eligible intangible assets, so patents, designs, software. Italy is essentially saying, you know, if you keep the brilliant minds and the engineering patents here, we will lower your tax burden.
So Ferrari's intense investment in engineering doesn't just produce faster cars. It structurally lowers the taxes they pay on their revenue, which funnels straight down to that 39.1% margin.
Precisely. It's a very elegant system for them.
So they have built this incredibly efficient, highly profitable machine internally. They engineer scarcity, they drive up the per unit value, and they optimize their tax structure.
They've mastered the internal game.
But, you know, an internal strategy is only as good as its ability to survive the real world. You can have the best business plan on paper, but if global shipping lanes collapse, you have a problem.
Which brings us to their external defense mechanisms.
Right, let's look at that. The geopolitical agility they demonstrated this quarter is remarkable.
This is where Ferrari operates less like a traditional heavy manufacturer and more like a global macro hedge fund dynamically reallocating assets.
Looking at the geographical breakdown, the first quarter saw significant geopolitical instability, specifically the surge of hostilities in the Middle East.
Which disrupted a lot of traditional shipping routes and economic flow.
Yeah, and because of that, Ferrari's shipments in EMEA, so Europe, the Middle East, and Africa, dropped to 43% of total shipments. That landed at 1,458 units.
A noticeable drop for that region.
If I am looking at any other European mass-market automaker, losing a substantial chunk of EMEA volume due to regional conflict would absolutely crater their quarterly earnings.
Oh, it would be devastating.
But Ferrari's overall revenue and delivery numbers barely blinked.
And that is because they utilized a strategy they call geographical allocation flexibility.
What exactly does that look like in practice?
To understand why this is special, you really have to look at how traditional auto manufacturing works. A company like Ford or Volkswagen builds thousands of cars and ships them to dealer lots around the world, hoping consumer demand meets their supply.
Right, building for the lot.
Yes. So, if a region experiences an economic crisis or a conflict, those cars just sit on the lot gathering dust.
And then they have to discount them.
Exactly. The company has to heavily discount them, taking a massive financial write-down.
So what does this all mean for Ferrari? It reminds me of an elite air traffic controller dealing with a sudden, massive storm system over the Atlantic.
That's a great comparison.
Instead of grounding all the flights, issuing refunds, and taking the financial loss, they just effortlessly reroute all those multi-million-dollar planes mid-air to different sunny destinations, ensuring nothing gets delayed and the revenue keeps flowing.
That is exactly what they do.
So Ferrari just brought forward deliveries to the Americas, right? The Americas saw an exceptionally strong quarter, taking 30% of total shipments, which is 1,030 units.
They did.
Do they just call up a customer in Miami and say, hey, good news, your car's arriving 3 months early?
That is precisely what happens.
Sure.
Because unlike those traditional companies, Ferrari doesn't have dealer lots full of speculative inventory. Every single car is hand-built to order. Their order book isn't a projection. It is a massive, concrete, global queue of buyers who have already paid deposits.
Real buyers waiting.
Yes. So if shipping lanes to the Middle East are compromised, Ferrari doesn't stop the production line.
You just pivot.
They simply look at the global queue, find the next customers in Los Angeles, Miami, or Tokyo who were scheduled for August, and bump them up to May.
That flexibility completely insulates their revenue stream from regional crises.
Completely insulates it.
They are totally agnostic to local shocks because their global demand pool is so deep and it so severely outstrips their controlled supply.
Right.
I mean, it is a level of operational invincibility that most CEOs can only dream of.
It is the ultimate luxury for a business, absolute operational flexibility. But, it requires that massive backlog of demand to function.
Right, you need the wait list.
Exactly. Which is why they have to constantly feed the mythos of the brand, ensuring that demand never cools down.
Which perfectly transitions us into what they are doing entirely outside of the automotive space.
Because you can only squeeze so much margin out of four wheels.
Exactly, before you risk diluting the exclusivity of the cars. So they are expanding into a holistic luxury ecosystem.
A full lifestyle brand.
Looking at the non-car revenues, sponsorship, commercial, and brand revenues jumped 14% to 218 million euros.
A very healthy jump.
And their other revenues grew by 17%. The detail that made me laugh was that the 17% growth was largely driven by Ferrari renting out their Formula One engines to rival racing teams.
It is a brilliant psychological play.
It's so funny to me.
Think about it. If your competitors literally rely on your engineering to even compete against you, it sends a crystalline message to the global consumer about who actually holds the high ground in technological supremacy.
Oh, totally. But the lifestyle push goes much further. They opened a new flagship lifestyle store in London.
Right.
They hosted a major fashion show. They launched the greatest hits exhibition at the Ferrari Museum in Modena.
All building the aura.
But here's where it gets really interesting. The detail I kept staring at, the one that initially made absolutely no sense to me, was the boat.
Ah, the hypersail.
Yes, during Milan Design Week, they revealed the livery for the Ferrari Hypersail. It is a 100-foot flying ocean monohull, a sailboat.
A very fast sailboat.
But I have to be honest, I am struggling to see the connection here. Why is a company famous for roaring V12 engines suddenly building a 100-foot wind-powered ocean monohull? A sailboat doesn't have an engine.
It does not.
The roaring internal combustion V12 is Ferrari's entire acoustic and mechanical identity. You take away the engine, and what are you left with? Just a red hull. Are they losing focus? Is it just a billionaire vanity project where they slap a prancing horse logo on a mast? Help me connect the dots here.
I completely understand the skepticism. It is incredibly easy to view it as a vanity project at first glance.
Right.
But if we connect this to the bigger picture and really dig into the physics, it makes perfect strategic sense.
Okay, I'm listening.
Ferrari is signaling that they aren't just an engine company anymore. They are the absolute pinnacle of human engineering, specifically fluid dynamics.
The fluid dynamics, okay.
Think about what a modern Formula One car actually is. Yes, it has a powerful engine, but the real secret is aerodynamics.
Right, the downforce.
Exactly. F1 cars are essentially fighter jets designed to fly upside down. They use the air flowing over the carbon fiber wings to create massive downforce, pushing the car into the asphalt so it can take corners at impossible speeds.
They are constantly fighting and manipulating the air.
Now look at modern elite sailing things like the America's Cup.
Okay.
These 100-foot boats do not float through the water like traditional sailboats. They use hydrofoils to lift the entire hull out of the water.
But they look like they're hovering.
They literally fly above the waves. The engineering challenges to achieve that fluid dynamics, managing extreme wind resistance, utilizing hyper-lightweight composites are the exact same physics problems that Ferrari's engineers tackle in Maranello every single day.
Ah, I see. So it is a flex.
It's a massive flex.
It is Ferrari proving that their understanding of aerodynamics translates to a completely new, incredibly difficult frontier, the ocean.
Exactly.
And by launching it at Milan Design Week, they are positioning the boat as high art and elite design, not just a sporting vessel.
It elevates the brand's prestige immensely, and that halo effect directly fuels the desirability of the cars.
I see how that feeds back into the core product.
It tells the ultra-wealthy consumer, when you buy our car, you aren't just buying transportation, you are buying into the most elite applied physics club on Earth.
Wow.
It's the same psychological lever they pull when they introduce something like the new handling special configuration for the Pure Sang, which they also announced this quarter.
Oh, right, enhancing the existing luxury lines.
Exactly. They keep the core automotive audience engaged with highly engineered track-focused upgrades while simultaneously expanding the brand's aura onto the open ocean.
It's the same artificial scarcity and hype cycle we see every day with things like, limited edition sneaker drops or impossible to get concert tickets, just scaled up with extra zeros.
Much, much larger zeros.
It's fascinating.
Yeah.
So they are making a massive amount of cash through high margins, protecting it with geopolitical agility, and expanding the brand's halo.
That sums it up well.
Where is all this cash actually going? That brings us to their financial promises for 2026 and beyond. The metric the report highlights heavily is industrial free cash flow, which came in at 653 million euros for the quarter.
A very strong number.
Let's do an ELI 5 on that. Explain it like I'm 5. What makes this like the overhead?
Yeah, the factory electricity, the worker salaries, the raw carbon fiber, and those massive R&D budgets we talked about.
Right.
It is the excess capital that is now completely free to be returned to the owners of the company.
And they are returning it aggressively. They approved a dividend distribution of roughly 640 million euros.
Which shareholders always love.
Oh, absolutely. But what really caught my eye was the massive multi-year share buyback program. They spent 226 million euros buying back their own stock in Q1 alone, and immediately launched a new 250 million euro tranche in April.
They are definitely doubling down on themselves.
For listeners who might not follow the stock market closely, walk us through the mechanics of a stock buyback. Why does Ferrari buying its own stock benefit the investors?
Well, a share buyback is Ferrari applying their exact car manufacturing strategy directly to the stock market.
Oh, interesting. How so?
Think of the company's ownership as a pizza cut into 100 slices. If you own one slice, you own 1% of the company.
Simple enough.
If Ferrari takes their excess cash, buys 10 of those slices from the open market, and permanently retires them, essentially throwing them away, there are now only 90 slices left.
Right.
The company itself didn't shrink, but your single slice now represents a larger percentage of the total pie.
Ah, I get it.
By reducing the supply of shares, they artificially create scarcity, making every remaining share inherently more valuable.
They are engineering exclusivity in the financial markets, just like they do in the showroom.
Exactly.
But that requires immense confidence in their future.
It absolutely does.
And that confidence is plastered all over their confirmed 2026 guidance. They are boldly stating they expect to hit around 7.5 billion euros in revenue for the year with an adjusted EPS earnings per share. Basically, the profit assigned to each of those remaining pizza slices of 9.45 euros or higher.
They are setting a very high bar.
They're leaving zero room for doubt. But looking at the report, the foundation allowing them to make these bold predictions is the order book.
The famous order book.
The documents note that Ferrari's order book is now extending toward the end of 2027.
Let that sink in for a moment.
Yeah, if I walk into a dealer today with the money ready to go, I might not see my car until late 2027. I have to push back on this as a modern consumer.
Go ahead.
We live in an era where we get annoyed if a package takes more than 2 days to arrive.
Very true.
How does a company keep a customer excited for almost 2 years? How do you prevent them from taking their millions to a competitor when you force them to wait that long?
This raises an important question, and it's something that baffles a lot of people outside the luxury sector.
Right.
But the wait time is perhaps the most profound psychological insight Ferrari has into the ultra-wealthy.
Tell me more.
In a world where a billionaire can buy almost anything instantly, a watch, a house, a private jet flight, Instant gratification has completely lost its luxury status.
Oh, wow.
Instant is common, instant is for the masses.
That is a really sharp way to look at it. The friction is the point.
Exactly. For this specific clientele, the waiting period is the feature, not a bug. The wait builds the mythos. The process becomes a curated journey.
So they don't just take your money and ghost you.
Oh, definitely not. Ferrari doesn't just take your deposit and ignore you. They invite you to Maranello. You sit in a design studio picking out your custom leather.
The hyper-personalization we talked about earlier.
Right. And they send you exclusive updates, perhaps a photo of your specific V12 engine block being cast in the foundry. The anticipation itself becomes a status symbol.
You get to casually mention at dinner parties that you are waiting for your custom Ferrari to be finished.
Exactly. It is a hazing ritual for an exclusive club.
And the ultimate tease to keep that excitement at a boiling point, to ensure the customer doesn't lose focus, is right in CEO Benedetto Vigna's opening remarks.
Yes, the big tease.
He drops his quote about the world premiere of something called the Ferrari Luce, arriving in just 20 days.
Luce, translating to light in Italian.
Right. He describes it as bringing together extraordinary technology and the passion of tradition.
Hmm.
It is the perfect carrot on a stick.
It really is.
They have a backlog of customers trapped in a 2-year queue, but they are constantly teasing the horizon. It ensures that the moment a customer finally takes delivery of their car in 2027, they are already feeling the itch to place an order for whatever the Luce eventually evolves into.
It creates a self-sustaining ecosystem of desire. They manage the scarcity, the storytelling, and the physics so perfectly that the global demand just never cools down.
We have covered a massive amount of ground today.
We certainly have.
We started with the paradox of selling fewer cars to generate massive margins through hyper-personalization. We explored how they protect that revenue by pivoting seamlessly around global conflicts, leveraging a years-long order book to reroute deliveries dynamically.
The air traffic controllers of the auto world.
Exactly. We unpacked how they are taking the brand's halo off the tarmac and onto the ocean with a hydrofoiling hypersail, proving their dominance in fluid dynamics.
Not just cars, but high-end physics.
Right. And we saw how all of this locked-in demand funds, aggressive shareholder, returns through buybacks, while the CEO teases the mystery of the Ferrari Luce to keep the hype cycle spinning.
It all cycles back to that initial idea of the digital bouncer at the door, the engineered exclusivity. But looking at the sheer length of that order book leaves us with a fascinating philosophical question.
I'm ready for it. Lay it on me.
If Ferrari's order book is completely full until late 2027, when you put down a deposit today, you aren't actually buying a tangible car.
Because it doesn't exist yet.
The physical vehicle does not exist. Are you instead buying a futures contract on a piece of rolling art?
Wow.
And if so, does that long, heavily curated wait actually make the ultimate delivery sweeter? Does Ferrari's overwhelming financial success fundamentally prove that our modern expectation of instant gratification is actually the absolute antithesis of true luxury?
A futures contract on a piece of rolling art. I love that framing. It completely upends what it means to be a consumer at the highest possible level. Thank you for joining us on this deep dive. Keep questioning the systems around you. Keep looking for the why hidden behind the balance sheets. And we will catch you next time. Keep your curiosity ignited.